The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president and owner of the Dillon Gage Wealth Management Companies. For those of you new to the show, we developed this show to answer your financial questions. We try to do it in plain-spoken, easy-to-understand language that everybody can use. Obviously, we hope that you do business with us, but if you don't, you'll learn something on this show, hopefully. My co-host, Guy Allard. How you doing, Guy?
Pretty good. How about yourself?
I'm doing pretty good.
All right.
I just got back from Europe, and, is there anything worse than a 10, 12-hour plane ride?
It's a big deal.
Oh, it's awful. But all you listeners out there have never been to Budapest. I thought it was going to be terrible. It was actually nice.
How was the goulash?
Yeah, it was really nice. I was really shocked. I thought it was going to be pretty crappy, but it was. I went to Vienna and Budapest, and Budapest might have been nicer than Vienna.
Wow.
So very nice.
Who'd have thunk?
And the dollar is very strong right now, so going over there is pretty good. I had some friends also going from there to France. I said, a little hot zone there I'll stay out of there for a little while longer.
So you didn't have to pay $50 for a cheeseburger?
Yeah. That was Switzerland. Oh. A friend of mine said, it was $50 per drink in Switzerland. I go, but last time we were there 4 or 5 years ago.
Yeah.
It really was between 40 and $50 a drink. I was like, whoo.
That'll keep you sober.
Oh, I'm telling you. All right. Today's show, we're going to follow up a little bit about investor behavior a little bit from a week or two ago. Dalbar is a industry leading company that basically analyzes all the data from mutual funds and things like this, and they try to give you trends or come up with some kind of analysis or what is investor behavior. And that's what they do. It's a quantitative analysis of investor behavior.
They're very thorough.
Yeah, it's pretty neat. And if anybody wants a copy of it, you can call us at 972-715-2424. You can email us at Victor@VictorMcClure.com, wherever you want to go.
Or go to the website and get our phone number there.
ILoveMyRetirement.com.
Absolutely.
All right. Well, 2015, this is the end of 2015. It just came out. All right. The average equity mutual fund investor, all right, lost 2.28% over the last 12 months. Okay. The market actually made 1.38%. That means they were 3.66% less than the market. Then let's say you go to like the average fixed income investor versus something like the Barclays, aggregate bond index.
Right.
Well, the average person lost 3.11 in bonds last year. The index made 0.55.
Not good, but it's a lot better than losing 3%.
That's right. And so is that pointing that indexing is the only way? Not really. All right. The actual report said there's no evidence can be found to link predictably poor investment recommendations to average investor underperformance. So you might think they've got a bad broker.
Right.
It's giving them bad advice or trading too much or whatever. But the analysis of the underperformance shows the investor behavior is the number one cause. What do you think the number two cause is, Guy?
That would be fees.
That's right.
And plugging into your point, 2 weeks ago before we did the rerun when you were gone, we talked a lot about investor behavior and how much of an effect it has. This report really sheds light and magnifies what that is.
Right. The investor behavior, when people buy or sell, inflows into equity funds versus outflows. And a couple things are real interesting in this report. The average investor is actually right 75% of the time. That shocked me. 75% of the time, and still they underperform the market by like half.
It's absolutely.
That's how much difference it is. Because you're always trying to figure out, well, should I have my money managed? Should I manage it myself? There's nothing. You've heard me say this for decades on this show. There's nothing wrong with managing your own money. If you've got the temperament, you've got the education, the knowledge, you can. But it's so hard to fight your own inner, biases.
Yeah, I don't want to say demons, but let's talk about temperament for a minute and unpack that a little bit. We talk about emotions. One of the big reasons that investors underperform is because they don't stay the course. We talk about if you stay in line, you'll get to the cashier. If you keep getting out and trying something, then you got to get back in the end of the line, and it never works. There's all sorts of good reasons to switch advisors. If you don't get along, perhaps with your advisor, if your philosophies don't match, if you're not happy with the fees. But a lot of times what will happen is the market in general will be in a downturn or a correction. And one of the things the article also brought out is when the market does a correction, it usually hits all sectors. So diversity really isn't a shelter for you either. But the market's taking a downturn, a natural correction, and you kind of want to blame emotional. I want to get out. I got to do something. If I don't do something, I'm going to lose my money. And you may jettison some good stuff that if you made the right decision initially, and if you have the right advisor initially that's got you in the right stuff, you want to stay the course. Now, the difference, and where emotion makes it hard, is knowing when to stay the course and, of course, when not to.
Let me show you what the difference is. If you're an average equity investor, this is the past 30 years, and what they use to find this analysis, inflows and outflows out of mutual funds. You know, when people are out of mutual funds, obviously they can't make returns. They're in them. They're making them, right? Over 30 years, the average mutual fund investor made 3.66% a year. The S&P 500 made 10.35. Inflation was 2.6, so you barely beat inflation, and you had to go through a lot of down years and a lot of turmoil during that 30 years to get that. You look at 20 years. Average mutual fund investor made 4.67 when the market made 8.19. You're basically getting half of the return you should, and mainly, like I said, it's from investor behavior, not from the recommendations you got. It's also from, like I said, investor behavior and how you perceive the market.
Your emotion. Keep in mind, as you're hearing these numbers, 3.66 in equity funds, and the S&P did 10.35 over the same period of time, there's different portions of your life. We're not talking about a distribution phase. You've heard Victor and I talk over and over. That completely skews the numbers when you're withdrawing. This is when you've got time or for the money that you can let there and you can stay the course.
They've done this every year for 22 years, this particular report. The results are always the same.
Isn't that amazing?
Every time. It's the same. You're basically getting between 40 and 60% of the actual return because of the biases and investor behavior. That's why it's hard to put aside.
You know what was interesting about the article, Vic? It talked about investors are always 1 month behind. Did you read that? Because you'll see the market go down and then you move. Well, it's already gone down. You'll see it go up and then you'll get in. Well, it's already gone up.
That's exactly right. And so that's why here's something out of the article or the report. Acting in the investor's best interest should include, this is for advisors like myself,
right?
Should include affirmative practices to curb harmful behaviors. That's the main thing. You've got to make sure that you get rid of all the biases you have and all the emotions you have, but it's pretty hard. That's why, back to what I said 5 minutes ago, anybody can manage your own money. But fighting your own demons or your own biases is so difficult. And that's why the average investor does half. And that's why for most people, not everybody, most people, I think having an advisor is going to be better. Now, don't get me wrong. The number 2 reason they underperform is fees. You can't pay high fees and get an advisor. You're counteracting each other.
And we can help you with that.
Right. You need having an advisor helps you, helps you not hurt yourself. And having an advisor also, if you can get lower fees, like our managed programs are only in individual stocks and ETFs because you got lower costs there. People don't realize the average mutual fund fee. It used to be higher. It used to be 2% management fee. Now it's about 1.25% on average, according to Morningstar. But what in mutual fund companies did, variable annuity companies did this, all these companies, they said, people are starting to pay attention to these management fees. How are we going to still get our fees, but somehow they don't squawk about it?
You talking about soft costs?
Soft costs. That's exactly right.
Ah.
Think about this. I'm a $1 billion mutual fund. I can get trades for 10 cents. I go to the trading desk and say, go ahead and charge me $20. What do you mean charge me $20? We're going to split the cost, split the difference. Or you're going to put Bloomberg terminals in all my,
and save me cost. Exactly.
Yeah. So either way, they got their money. But those kind of costs eat you alive. And that's why I'm a big proponent of ETFs, index funds. People always ask me, well, you're an advisor. You hate index funds. I go, I know. I own index funds. I've always owned index funds. I think they're fantastic.
All of us do.
Right. But I've got professional money managers, and I've got I can see them pulling out of the market because all their indicators are hitting. Well, I'm pulling out too. The average investor doesn't have that.
Did you catch that? Your emotion is removed when we manage your money, and our emotion is removed when we have advisors manage our money.
That's right. That's what people always ask. They go, well, how come you don't manage money? I go, well, just one of the management companies I use has 10 PhDs, 2 economists, 2 CFAs. I don't have that. The Fidelity broker doesn't have that. The Merrill broker doesn't have that. But I want that.
Absolutely.
And so we hire the best management teams out there to manage your assets, so it keeps it out of us emotionally or anybody else, and maintains our legal fiduciary responsibility to put your interests ahead of ours, all of those kind of things. And we're going to talk more about the Dalbar Investor Behavior Study when we return from the break. Remember, if you have any financial questions or you'd like a copy for yourself, don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you'd like to take advantage of our no-obligation, no-cost retirement plan, retirement stress test, and Social Security analysis, don't hesitate to call our hotline at 972-715-2424. If you'd like to meet us, go over your situation. Remember, there's never a cost, no obligation. We're the opposite of high pressure anything. We're just going to give you some good information, whether you deal with us or not in the future. You can take this information with you, and it really, really will help your financial planning and retirement planning.
And I know procrastination gets us all in our own little areas, but if you're 59 and a half and over, it's really a sweet spot for you because your current 401k can be portable. You're making plans for retirement, whether you're going to work to 66, 67 at full retirement, whether you're going to go to 70. It's a real good time to get your hard bills taken care of. Take a look at the inflation hedge that you've got in the market. It's just an opportune time.
We're about to come that time of year where you're getting some of those lump sum pension offers.
Yep.
And remember, you want to shop those to every carrier available out there because sometimes you can get a lot better deal, or sometimes the deal they're offering you is pretty good, and we're going to tell you the truth either way.
Absolutely, and show you black and white.
I think 2 years ago, it was about 80% they were bad deals. You needed to do something else. But the last year, I think it was about 70% they were good deals. The lump sum that they were offering was pretty good, or the pension they were offering was
and
pretty
it depends on the actuarial tables
Right.
they use and how long you've been in the
Right.
in the system.
And remember, just call us, and we have no problem, 972-715-2424, or go to ilovemyretirement.com. We've been talking today about the Dalbar. That's a company that there's their 22nd study in a row it's called Quantitative Analysis of Investor Behavior. And it's talking about how our own biases and our own behavior as an investor gets us to return about half of what the actual market returns. And people do all kinds of things in their head. They're like, that's crazy. I've been investing for 30 years and I've got this much now, but they forget all the money they added. And yeah, it's higher than what they started with.
Absolutely.
But they could have got double what that was if they would have just been able to put aside the biases, which is really hard to not be emotional with something you saved your entire life.
And as we get in our 40s and 50s and 60s and 70s, it's hard to change our thinking, our behavior.
Well, let's read an excerpt right out of the report. After decades of analyzing investor behavior in good times and in bad times, and after enormous efforts by thousands of industry experts to educate millions of investors, imprudent action continues to be widespread. It has become clear that improvements through investor education have only produced marginal benefits. With the internet age and all the different seminars, oh boy, if I get I'm in that perfect group, over 50 in a certain, age, a certain area.
Right.
It gets every seminar invitation, Ruth Cruise, blah, blah, blah. Come to my seminar, learn about this. I get tons of them. And all of those educational seminars have produced, it still can't overcome our own biases and our own investor behavior.
Well, think about it. You've got this group that's got 30 years of quantitative analysis, right? And they've studied it all, and the inflows and outflows of the mutual funds, and they sit down and they try to educate and help people. And even with all of that knowledge and all of that information, people still believe what they believe.
We already had this a couple weeks ago. We talked more in detail, so I'm going to go a little more brief on the biases. We talked about 5 major biases, and some of them are lumped in. They put it down to 9 biases, but loss aversion is one of them. Expecting to find high returns with low risk, and they end up finding high returns come with high risk, or low returns come with low risk.
I call that greed.
Then you've got narrow framing. I see this a lot. They're making decisions without considering all the implications. You've got herding, copying the behavior of others, even in the face of unfavorable outcomes. Nobody jumped in all in tech stocks in 1990 when they started going up. They really jumped all in about 98, 99 before it went down.
Yeah, 2000 when it's going down.
There's regret, treating errors of commission more seriously than errors of omission. There's mental accounting. This one I get all the time. People say, no, you don't understand. My stock piece has made this much. My other pieces make this, and that's the only one I really manage. Overall, they made 2% a year, because they had 80% in cash, making 0, and then they had, 20% in stocks where they made 4 or something like that. People still don't realize. I ask people all the time, what do you think the market's made the last 15 years? And I get 8, 10, 12%. It's made 4.
Yep.
And you had to watch your money go down 50% twice.
With dividends.
In that period. Yeah. So then you've got diversification behavior. Seeking to reduce risk simply by using different sources. There's other things you have to do. Anchoring, relating to familiar experiences, even when inappropriate. Anchoring is one, like I said, I'll tell you, when you get in a stock, you're kind of anchored to it. Let's say if it goes up, well, I don't want to sell that one. I'm making money there. Then if it goes down, well, I can't sell it now. It's down.
That's right.
When it gets back to even, I am getting out of that thing. And then it shoots back up, and you're like, well, hell, that one made more than anything else. It might keep going now. You get stuck. You can't buy, you can't sell once you get in. All right. Then there's optimism, believing that things happen to good things happen to me, and bad things happen to everybody else.
Like you're going to will it to success.
That's right. And then you've got media response, tendency to react to news without reasonable examination.
That's a big one with the internet.
Oh my gosh! I told you, if you look on the internet long enough, you'll find 100 people that hate puppies. There's some crazy people, bad advice, and everything else.
And 10,000 people that want you to invest with them.
Oh, yeah. So you got to be really careful with this kind of stuff. But the past 20 years, equity mutual fund people have only stayed in an average of 4 years. And that's usually only in bull markets. Every other time they're in and out. But just like our plan talks about, we'll talk about our plan will show you can stay in the market side, not worry about the other when we return from the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you'd like to take advantage of our no-cost, no-obligation retirement analysis, stress test, Social Security Optimizer, or if you'd just like to talk about your finances, don't hesitate to call our hotline at 972-715-2424. Again, 972-715-2424. Or you can go to our website at ilovemyretirement.com.
Hey, there was one point, Victor, in the article that I wanted to at least bring out because we see it happen, or I see it happen fairly often. It's the article went on, or the report went on to say one thing that all negative behaviors have in common is that they can all lead investors to deviate from a sound investment strategy that's narrowly tailored, it's focused for their goals, risk tolerance, and time horizon. And that's talking about emotion coming in. You've got a plan, you've got a good advisor, you're on course, but yet you hear something better and you switch everything. Or the market's in a brief downturn or an extended downturn, and you jettison good stuff.
Right. I listened to one of the smartest people I know. He's a head of Guggenheim.
Well, thank you. Oh.
And he was actually thinking the market was going to go down this year.
Right.
But he's changed his tune a bit. He goes, the Fed's inability to raise interest rates and to keep them low, not caring about savers at all, just to care about keeping, real estate prices high and blah, blah, blah. He said it could be another year or two. It's not going to be good. He said this summer might not be good. But he said, I don't think you're going to have a correction for between a year or two.
I heard just earlier in the week that the Fed, or the proponents are thinking, prognosticators are thinking that the Fed may go ahead and raise a couple times this year.
I heard that too.
they were talking about all the stocks and the companies, you name them, whoever it is, really aren't earning anything. But the only place investors have to go right now with the low interest rate environment and everything else is the stock market. And that in itself is kind of perpetuating the market.
And that's why this reinforces what our philosophy here is at Dillon Gage.
Absolutely.
All of these, all the average investor out there doesn't have access to the information we do,
or the desire,
right.
Nerds. Yeah.
We have 30 years doing this. And every single time it reinforces why we do what we do. Think about it. Our philosophy is if you have $10,000 a month in bills, secure $10,000 a month coming in to your bank account, at least, or 11, 12, whatever. But have more coming in every month when you retire than is going out, period. What that does for you, first off, it knows you're not going to run out of money, right? You're going to make sure you're going to never run out of money. You and your spouse will never run out of money, number one. That's the number one thing it does. But what else does it do? It also allows you, if you have a managed program to help cover inflation, you're still in the stocks, right? It allows you to not have to deal with all the investor behavior that has caused the average investor to make half of what they actually should.
Bad decisions at the
That's
wrong
right.
time. I'm seeing a lot of clients right now, Victor. You remember the old College of Financial Planning, if you make 80% of your pre-retirement income in retirement, you'll be happy. I'm seeing a lot of clients now they're working a little longer, so their Social Security is a little bigger. They're not quitting at 62, so they're 68, maybe 70. They've got enough saved in their 401k to take care of the hard expenses and maybe a $100 or $400 a month, some small pension. But I'm seeing a lot of them getting the same income in retirement starting that they did when they retired. So basically what happens, their check doesn't stop, just the work does. That's cool.
Right. And the one I'm seeing, that 80% figure was the old days. I'm thinking right now with internet shopping and things like that, I've got people earning, spending 90 to 110% of what they did before retirement.
Oh, yeah.
And so I would always plan on exact same lifestyle, possibly, spending the same as what you're doing. Because if I quit working, what exactly am I saving? Gas money to work?
Dry cleaning? I don't know.
Dry
Not
cleaning,
much.
Not
Yeah,
much.
no.
It's not as much as you think. Everybody thinks, oh, no, I got 10 grand a month in bills. As soon as I retire, I'll have 3. Really?
Yeah. Not unless you sell the house and downsize, yeah.
Yeah, there's certain things, but it reinforces if you have an income plan that guarantees you'll never run out, it allows you, even if you manage your own money, to stay in that market, to get the kind of returns you deserve. But I think even better, having a managed program on the side instead of, just manage some yourself, but have a managed program, that is even better because it's more of a mechanical type system that doesn't get caught up in elections and everything else. How many times do we hear a week do we get calls going, I think the election is going to be terrible and I want all out of everything? And that's human nature, but you've got to fight human nature if you're going to succeed in the market. Now, some people make so much money that they don't put that much weight.
They can't spend it all?
Yeah. They don't make that much weight in actually making a lot in the market. But to me, if I'm going to risk my money in the market and I'm getting half of what I should because of human behavior, well, what if I can eliminate some of that?
That's right.
And that's what these programs do. And that's why our philosophy of getting the bills paid first. Number one, have your bills paid, have the paycheck coming in, have a retirement paycheck coming in, add that Social Security, all covers your bills. And then you have the stock market to cover future inflation, have that liquidity that you might need if your grandkids need money, if your healthcare cost goes up. You got all of those things set, but you can relax. Because I'm telling you, if you got 100% in the market and that thing drops 50%, I don't care who you are. I don't care how big your stones are. You're going to be freaking out. All right. You're going to pull out of the market. Something's going to happen. And remember, if you have any financial questions, you'd like to talk to us about your finances or take advantage of our retirement analyzer, stress test, Social Security optimizer, don't hesitate to call our hotline 972-715-2424. Again, 972-715-2424. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Hey, in this segment, Guy and I are going to discuss how to properly use your IRA and qualified plan assets in retirement. I've heard so much conflicting advice over the years on what you should do. I'll tend to tell you our philosophy and see if you agree. Okay, retirement plans, that's your 401ks, your IRAs, your 403bs, 457s,
SEPs,
pensions, blah, blah, lump sum pension stuff. All of them have one thing in common. They're specifically designed for future income. For that, they let you tax defer the whole thing, right? You're not paying tax on any of the gains for up to 40 years or something, right?
Right.
They're letting you they're making it judgment proof. No matter what, somebody can't slip in your front yard and take your retirement account.
Now that's not for your benefit, that's for theirs. They don't want to lose that money that hasn't been taxed.
That's right. They got future tax deals.
That's right. No, you can't touch that money. That's partly ours.
No, I never thought about that.
Well, it's true.
I was like, they're protecting us, but they are protecting themselves.
I think so. It's a conspiracy.
Right. Well, those plans, when you turn April 1st, the year after you turn 70 and a half, something called required minimum distributions have to be taken out.
AKA forced income stream.
That's right. They make you have a forced, because if they don't force you to spend this stuff, since that one's fully taxable and your other stuff might be after tax, you're more willing, I don't want to spend that. I may leave that for heirs. And then there goes to another lifespan, which is longer because they're younger.
Right.
And they never get their tax money.
And I may be jumping the gun here, but same example. If you have a $60,000 emergency, you want to use the non-qualified funds, because if you're going to tap into your savings, these qualified monies, you have to take out 100, right? Because it's going to be 100,000 in income this year. You're going to pay 40 in taxes to net your 60. It's not efficient.
Right. So what you've got is a forced income stream. It will never be depleted to zero typically because it's a percentage. Now losses and the RMDs can deplete it really quickly and get really low, but it's always a percentage. So we know we've got a depleting asset there, okay? Just like Guy said, you got $1 million IRA, you're not going to go buy a house or a boat with that thing. I understand what these real estate people tell you. Oh, you can buy. Don't ever buy real estate with a retirement account. You lose all the benefits of owning real estate except for the appreciation, but everything else you kind of lose.
That's absolutely correct.
And you have to use money from IRA to make air conditioner goes out, and you used to do a whole IRA. Well, now you just cause a taxable event of $1 million into your income for that year because you have to use IRA funds to fix everything. If you spend $1 to fix anything, that's right, they got you.
Yep.
And remember that 30, 40 years it takes to get their tax money? IRS gets it all up front now. You just triggered a tax event. So don't put real estate in IRAs or IRAs in real estate, whatever you want to say.
Kind of gets into the Roth IRA deal, but that's another time.
So you're not going to spend lump sum that money. Think about this. You want to spend $1 million. Are you going to sit there and get the highest tax bracket possible? You're only going to get $500,000 out of $1 million anyway. Or let's say you got a $400,000 IRA. You're not going to cash it out to buy a boat because you're only going to get $200 from it, right? It's automatically going to put you in the 39.5% tax bracket plus the extra Medicare
tax. That's right.
Plus, it could trigger investment income, Medicare tax of 3.8% on top for your other stuff. It is a bad, bad thing. So let me get this. It's a forced income stream. You don't ever want to lump sum take a payment out unless you have to. It's emergency. Obviously, you got to do what you got to do. So what is it good for? It's really good for a future income stream. So what we do here is, let's say we take that money and then we put it over in an annuity. Yes, I know people hate annuities, blah, blah, blah.
Ken Fisher.
They used to be really hate annuities, but what you're trying to do is you're putting the type of money into where it should be. What if you could turn that $1 million IRA into $6 million? $6 million in payments. I have so many people tell me that I want something that's going to pay me principal. I keep my principal number one, and I want to get interest on it. And so I did an analysis for them and said, okay, you've got this $1 million. Let's say you could get a 6% government bond.
Repeat that. Let's say you could get a 6% government bond.
Right now, 30-year bond. 30-year government bond is about 3.5%.
Yeah, government.
We haven't seen a 6% government bond in decades or whatever. But let's say you could.
But you're being generous.
That's right. I did an analysis of a 35-year retirement. This person retired a little younger. But it was $2.1 million in interest, right?
Plus $1 million
But they get their $1 million back, so they got $3.1 million on this fund.
35 years?
And that's a really good way to maximize money. If I could get a 6% bond, which I can't, right? So it'd probably be half of that if I had to do what they're actually paying now. I said, well, we could put in an increasing income annuity that over the exact same period paid $6 million, but you didn't get your principal back. So you got to ask yourself, do you want the principal to total for
$3 million one,
$3 million one total, or you get $6 million?
and no
even
corpus.
Even if you died 10 years, it's always higher, and it's always higher than a 6% bond. That's how much increasing income these have.
And the difference, if I can real quick, when your bond, if you exhaust the funds in your bond, there's no more income. If you exhaust the funds in this fixed annuity, increasing annuity, you still get the payments. 1, 2, it increases as the markets increase each year, even if there's no corpus.
We showed that 17 on $1 million bucks, been paid for 20 years, ran out of funds, still getting 17 grand a month. It kept going up while you have no money in there to 25, 27,000 per month. Now remember, you only put in $1 million bucks. You're getting 27,000 a month, and you hadn't had money in there in 10, 15 years. It's the biggest income generator that I've ever seen. And so what we're trying to do is, if we know this is a depleting asset, lump sum spending it is ridiculous, why not get the absolute most income you possibly can out of that money? And if you got extra to spend, then you have extra to spend. We'll talk about it more when we return for the break. If you have any financial questions, don't hesitate to call us at 972-715-2424. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Delbar Report.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Before the break, we were talking about how to properly use retirement account funds. IRAs, 401ks, 457s, SEP plans,
Just try to
simple
help
IRAs, all that stuff.
people from making mistakes.
Right. And these are different than Roth IRAs. That, although they can be used in Roths, don't get me wrong, I prefer the qualified money for the reasons we talked about. Because think about this. You got a big old 401k there, or an IRA. You can't lump sum spend it because they're going to take half of your life savings just from a tax deal, right? If you're under 59.5, they're going to add another 10% to it. And we talked about 39.5% taxes, another 1% in whatever you call it, 1.5% in Medicare.
Tax, that's right.
Then you got you might have triggered investment income of another 3.8 on your other stuff. You could pay for horrible taxes by cashing a large IRA out to buy something. So you're not going to do that. It's a forced income stream. You're not going to die with the money anyway. It's going to be depleted a lot because as you get older, they're going to increase the amount you have to spend every year.
Every year it goes up.
So you got a depleting asset, forced income stream that you can't spend something on lump sum. Okay? So why not use that in something with increasing income? Even if your money runs out, the income never stops till both you and your spouse die and increases. We're talking about $1 million was produced, and it started at $7,000 a month, which is $84,000 a year, going to $27,000 a month in income. These are for life. Okay?
And take that and combine that with your Social Security of you and your spouse. It augments your Social Security, and if you're fortunate enough to have a pension, that's fine. But take your Social Security and add this to it. It's a nice income.
By maximizing the income on those IRAs, it frees up your other assets. So let's say you can have your stock market stuff. Well, your bills are paid by the annuity and your Social Security and your pensions, right? Covering all your bills. You even got extra there. And also, even if you can never run out of money, by the way, never, ever run out. That's number one. But it allows you to stay in the market more with your other stuff. You can withstand any kind of bear markets that come around or fluctuations or volatility.
You can do legacy planning.
There's so many different. And what do you want to leave? Do you want to leave your kids this IRA that they're going to pay half on 50% tax on too?
Because what do they do when they get the inheritance?
Within 99% spend it within 18 months.
Which means they're paying 40% on what you leave.
So do you want to save that over, or do you want to leave the money you've already paid tax on? Stock market money where you get a stepped-up basis. You could have paid $5 for these stocks. They're worth $200 a share. They start at $200. No taxes beyond that. They only pay taxes from the date of your death on the increase. So it allows you to leave money to heirs the way it should be left. Don't leave the money, the 50-cent dollars. Leave the 100-cent dollars. It also allows you to have the liquidity that you want. Remember, that IRA, as liquid as you think it is, because of the taxation treatment of it, it's not that liquid. So having a 5-year annuity, 10-year annuity, doesn't matter to me. I'm not taking lump sums out of that thing anyway. I'm just going to take income, which is always free to take. So, but if I have an emergency, by the way, some of them allow 20% a year you can take out without a penalty. So any kind of money I want to tie up, that's going to be income producing money. That's going to be retirement money. So I'll tie that up and I get an income stream for life. Remember, we don't do it like they used to. Your heirs always get the balance. Your money still grows while you're getting an income stream. You're not locking in today's horrible interest rates. In the old days, when you bought an annuity, you locked in these interest rates for life.
And when you were gone, the money was gone.
Yeah. Today, the index annuity income riders have nothing to do with today's interest rates as far as the payout. It's just your life expectancy. And so at this age, you get this payout percentage. And so you can cover all those different things. Let's say that in 10 years, market goes crazy, and I can get an 8% CD. Well, get rid of the annuity and buy the CD. I'll be in line right in front of you. And we're going to get me a bunch of CDs, right? And so it's flexible. It's liquid. There's all of these things that you need, but your other money is now in the stock market with favorable tax treatment.
And nothing makes this more clearer to you than seeing it in black and white. Some of us are audio, some of us are visual. It really helps to be visual and see this. The financial analyst that you hear Victor and I talk about all the time, and we really mean this from the bottom of our hearts. There is no obligation. Yes, we'd love to earn your business. Yes, we could do a great job for you. But if nothing else, allow us at least to get you and your plan in the financial analyzer and take a look at it. It'll show you the relief on your non-qualified money. It'll show that it'll last longer in your life by having the fixed income stuff taken care of.
Right. By doing it this way, we've allowed people to keep their money together and live off the interest, like something you thought you were going to do 30 years ago.
Right.
I'm going to save $1 million. I'm going to live off the interest.
Be it.
We've been able to accomplish that on many, many people. You just got to think a different way by using retirement funds for your income stream. Because remember, that's what it's designed for anyway. It allows all these other things to happen for you. And we'll show you too. Right. There's a reason why people say, why did, I was a nuclear chemist for the military. I get a lot of engineers and doctors. Why do I get a lot of engineers and doctors that do this? As far as the occupation goes, it's by far the biggest set of clients I have. It's because I'll show you in writing. I don't like sales pitch and a bunch of BS. I'm going to just show you the numbers. You decide. You could say the numbers. All right, you show me your plan, what you think, or your advisor's plan. I'll show you mine just on the numbers alone. And it's overwhelming evidence that you can make more money, have more money, leave more to your heirs if you plan the right way. Retirement planning is not financial planning, something they did. You can't have the same allocation when you're 30 as you're 60.
You have to plan. That's
right. We do that plan. Don't hesitate to call us. We'd be more than happy to take advantage. There's never a cost or obligation. 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Again, 972-715-2424. I'm Victor McClure for Guy Allert. We always, always appreciate your time.
The preceding show is paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.